Hi. So, if over the long term, share prices should should track earnings growth, then do we have a minimum hurdle? What sort of earnings growth are we looking at a stock level and at the portfolio level?
So the investment returns, portfolio returns, can come by way of three sources. Uh, One, as you rightly mentioned, is earnings growth. So if a company was earning 100 now and now it's earning 120, then one would expect that stock price would be higher. That could be one source of growth. The second source of investment return is dividends, where the company gives you cash flow saying, for the year we made this much profit and now this much is what we are paying out. So that is the second source of return. And the third source of return is the uh, P rating or D rating. So re rating or D rating. So if the price earning multiple goes up, then you earn more than the earnings growth. If the price earning multiple comes down, then you earn less than the earnings growth. Uh, so you are right. Over the long term, typically the company stock price will reflect longer term earnings growth. But sometimes you can buy a high growing company and still lose money. We saw the example of, let's say, Infosys, where for 6 years people did not even break even because they overpaid for growth at some point in time. Uh, at the same time, sometimes you can get decent returns from even flattish kind of companies. So, for example, if a company is paying out dividends at the yield of 15% per annum, and it's a company which will not grow very well, but which will not decline as well. So, in even in such a case, you can earn a decent rate of return if your buying price is correct. So, as such, there's no minimum growth rate that we require from our uh, investee companies. What we try to do is try to figure out what will be the sources of return on this company, and on a total return basis, how much do we expect to make out of this. So again, a random example. Now uh, we spoke about NMDC and the iron ore company. Now it's a cyclical company, it's not a long term compounding growth company, but uh, it's a company at whatever 30,000, 40,000 market cap, and the 20,000 crore asset which is not being ascribed any value is being spun off. Now that you are getting for free. So uh, for your holding period, you can earn a decent return even in companies where the long term compounding is not happening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.